Welcome to another video. My name is Robin, and as per usual, I am joined by Xi Jinping himself. No, just kidding. I'm joined by Kirill. And today we're gonna dive into Alibaba because quite something happened on the stock market this week. So we thought it would be interesting to cover what happened and if any of it makes sense. So what we're gonna discuss is what's in the news, what are the fundamentals of Alibaba, what are their important ratios, and finally, this is the value that you're going to get out of video is what is their valuation. And basically, this will be the starting point for your own due diligence. So you can take this video home, you can be like, cool, it's either over, under, fair valued, and you can make your own decisions, start your due diligence. Do you want to buy the stock, yes or no? But before we go any further, if you like the value that we give you in these videos and in our other videos, then please consider subscribing and liking the video. We will post regular videos per week, and also we can keep you posted on the progress of our web app, so you'll be the first one to know when it releases, and that will be quite soon actually. So Kirill, let's dive into the news.
Yes, sir. Basically, what happened last week was pretty interesting because China and its central bank unveiled the most aggressive stimulus ever since pandemic periods of time, which was quite a few years ago. And the whole stock market, especially the Chinese area around it and the indices, they went nuts. Because simply put, finally the Chinese economy got the injection of money and got a little bit of less strict economic environment to work in. And everyone got very happy and very excited. And what we thought would be nice, without jumping into the specificities of the stimulus and what it unveils and how it would impact the economy, we can just check, for example, the biggest company that's in ever known, let's say, for the Western world, which is Alibaba. And I think Robin and I have a little bit of history with the company, especially Robin. I don't want to poke it that pain any further, but we thought it would be at least quite interesting to see how did the company develop ever since the pandemic times, and especially price-wise, what would be the fair value of it, and what can you actually do about it? Is it a good investment or not? So let's dive into it.
Let's go in. So yes, Kirill already mentioned there's quite some history between Baba and myself. So still a shareholder, not a proud one, just riding out the waves, let's say. So when I bought it in, the first time I bought it, it was at like 150. So still trying to break even after it seems to be such a long time, but 2021. So yeah, still recovering from that, and it never hit fair value for me ever since. So I have been holding off of buying it. So it's actually quite interesting to see in this video whether it's time to start dollar cost averaging maybe. So let's go into the fundamentals, Kirill.
Yeah, sure.
Is there anything good?
I would say something to start with is that big, huge red graph for the past 5 years, when the highs of the Alibaba stock was 310 in October 2020, and then it just got destroyed. It got demolished to 63 bucks. I'm sorry, I don't really want to keep on poking that, but it just hurts to see.
You keep doing it.
I'm sorry. I do not want to do that, but it's, just to put the drama into the video so people are like, oh my god, But at least you can see a little bit of the recovery, right? So from the lows of October 2022 of 63 bucks, it got back to 110, 107 at the moment. That's nice. That's good to see, right? At least there is some momentum picking up, at least on these news about the economic stimulus in China, right? So
Yep.
That's good to see. At least there's some. So this Frankenstein is not dead. Let's say that's a
Exactly.
good sign. Yeah.
Yeah, and also their stock price tumbling has also to do with the leaders changing a lot. So of course Jack Ma disappearing for some time, then new leaders coming in. They didn't know what the direction they wanted to take. So it has been a really rocky period for them. But it's good to see that they are at least getting some kind of some kind of stimulus. Maybe that helps them to get back on the track.
I would also say on top of that, right, what we have in the Western world, especially in US, is that the stock market is highly based on the money, right? An injection of cash, let's say, into the stock market, of course. And as soon as, for example, the American or European markets are overflown, right, eventually China would follow as well, because people would be thinking like, okay, where to park their money, right? But as soon as we hit the tariff wars with China between US and the country, and keep on growing concerns about the geopolitical situations and stuff like that, people probably figured that this is a big risk and they decided to pull out, especially when it gets to the requirement from the Chinese stocks to, if they want to be listed in the US, they also have to provide the audited documents. And the Chinese government doesn't really want to disclose that, so that's why that's another uncertainty which is piling up. So if we're
Yep.
talking about the shareholders, potential shareholders that are in the Western world, not that many people won't have that. But if you're talking about the domestic ones who would be interested to buy Alibaba and any other stocks, they have some good probably companies to deal with, especially at such low prices at
Yeah,
the moment.
exactly. So let's dive into Baba. So what we know now is that they have a PE ratio of 18.5. I'm gonna classify them in the tech industry. It's really difficult to put them somewhere else because they do a lot of things. So for the tech industry, it's about 38. So you would say it's quite undervalued comparing just for the PE. You're buying basically at, yeah, half the PE ratio you would normally buy a tech company at. They also have quite good margins. So the gross margin is at 32.31%, which is really good. We're normally looking for 20% and above. However, the operating margin is on the lower side, but we can look into why that's the case. Something else that we might want to uncover, or are we ready to go further?
I would say also probably good to do the cross comparison, right, to any other companies, like for example Amazon, like Google and stuff like that, because when it gets to cloud computing, as you can see in the description, right, so Alibaba also has cloud computing division. They also have commerce, which is Amazon related,
No.
right, quite similar. The American alternatives, they're way more expensive, even though, let's say, the metrics wise, they could be more or less on par. I'm not talking about the dividends, but they maybe have a little bit of better margins because they do not pay dividends, right? And but the PE is way higher. So if you know the business very well, if you know the specificities of the market in Asia and in China in particular very well, could be very good for grabs for sure.
Exactly. And then we can also see some positives for the company foundation, except for the average share buyback. So they have been diluting in the past, but it might be do some acquisitions. We can, if you want, you can look into this further, right? But these is the first steps of your valuation process, and we can see that their revenue growth has been growing nicely at a 30% pace. We can see that their long-term debt is covered by free cash flow, which is really good to see as well. Again, as we always say, if they want to pay off all their long-term debt, they will be able to do so. So if there's any bad weather, as to speak, they can easily pay off their debts and be done with that. Net income growth has been growing as well with 15%, which is also really good to see. And their free cash flow has been growing, so they are making things a bit more efficient. So green flags across the board, except for the buybacks.
Yep.
Let's get into the key ratios.
Yeah, I think also what's important to highlight, at least when we're talking about the revenue and the gross profit, right? It kind of plateaued at 2022, at the year of 2022, right? Um, you don't really have any sky high growth after that. Also, probably because of the economic environment, no stimulus, no cash injection, right? People are not maybe willing to spend extra buck on the products and services Alibaba offers. So maybe if the economic environment is gonna get better, revenue is also gonna get traction and get some more increase potentially.
Yep.
Yeah, more like a speculation, of course, but we will see in the future. Yeah, I'm just scrolling through because what we can see also, for example, the free cash flow, yeah, is gradually also decreasing, which is also something interesting to look into because A, the free cash flow is decreasing, but then B, they also dilute you a little bit, so the free cash flow per share is going even lower, which is not that nice. But then we can see, yeah, in the ratios there are some quite a few greens, right?
Yeah. So, for example, for the research and development, it's around 20%, something we would like to see. So, even though they're a tech company, cloud computing, whatnot, they are able to keep this at a sustainable level. And this is what you most definitely see with companies that have some kind of moat, some kind of competitive advantages. They don't really have to constantly improve their product at such high margins. to stay relevant. So that's something really good to see. The selling and general expense ratio is a bit higher. So I see the average is 25.14%. Normally you would like to buy or at least consider stocks that are below 20%. That has been above 20% for the past years.
Yeah.
Exactly. Um, yeah. So the free cash flow growth has been stable,
I would
just swinging a
say,
bit.
yeah, just please disregard 2024. It's a bit of a bug we got, but sometimes you can see quite some crazy free cash flow growth, right? But then you got some years where they are negative. They're just inconsistent. That's the only concern,
Mm-hmm.
So
Yeah,
you gotta be, if you wanna jump on the Alibaba train now, you better be cautious, right? In terms of how effectively the company is able to get the monetary value out of their products and services.
exactly. And then we can see here that they have been diluting in 2018, 19, 2021, and that they have been buying back shares in the past 2 years. So it's also interesting for your own future research to look into why did they do that. So why did they dilute you? Did they want to buy anything? Uh, you can, did they just need more shares or whatever? You can check it out why they did that, and then of course if it makes sense to you.
Or just simply pull raise capital, right? Because when the economy globally was doing great, right? When the interest rates were down on the bottom, and then at some point when Alibaba experienced some troubles with the stock price, they were like, okay, we can just start buybacks. And this is wise. This is very good to see because if the management believes this is undervalued stock, and in 2022 they bought back 3% and then 4%, that's pretty consistent. I would say that means that they have trust in the company and they're doing something about it to actually generate even more value to the shareholders if it's going to continue in this way. So that's, I would say that's a nice sign to see it, at least from the quick glance.
Yeah. All right. The gross margins have been decreasing a bit. There's
Consistently,
also
huh?
some, yeah,
Yeah.
and there's also something to figure out why. Why have they been having issues? Yeah, having their keeping their margins up. Same goes for their revenue growth. So that has also been stagnating a bit. Maybe
Yeah.
that's a bit related, and the operating margins are also decreasing. So I'm curious what's happening there. So maybe they're trying to, I don't know.
Again,
Maybe the competition is also just difficult for them. That they need to cut prices, make better deals. It hits their finances.
and on top of that, back in the days, China, like the whole Chinese economy in general, had more access to the Western markets, and now they
Hmm.
might have more complications with that, right? So, for instance, if they have to do R&D, they cannot do any dealings with companies like Qualcomm, where they can get software, or they can get hardware, So it means Nvidia, Qualcomm, Intel, any of these kind of big giants in US. You have to do it elsewhere, or you have to do it in house, which is of course probably gonna bump up the expenses.
Yep. All right. Let's go into the valuation. So if you have been with us for some time, you know how this goes. But here we can just do the adjustments and the estimations that we ourselves want to put into it. So for the free cash flow starting point, we most often use last year. That's of course the best benchmark you have is the one that's most recent. However, if for example you have a company that has an active free cash flow, you can adjust this so that you have some kind of so that the valuation is reflected a bit better. But also, if you have other details or some other estimations for the free cash flow, you can just put it in here. For the projected period, Kriel, what would you say between 2 and 5 years? I think 5 years is decent. They have quite some leverage in China.
Yeah,
They're
that's a
they're a
tough
big
cookie.
company,
Yeah,
but
because I would
it also
also.
depends.
Hmm?
Sorry,
No, go ahead.
so no, it also depends on geopolitical tensions, like you said, with tariffs and whatnot, and also how the relations with the West stay for them to prevail.
Exactly. Yeah, I was just about to say more or less the same thing, and the question is also in terms of, well, will the company stay there? Will it still exist in 5 years? Yes, for sure. It would be really hard because it's one of the biggest pillars of the Chinese economy, right? Period. Would it, for example, some of the assumptions that we're gonna be putting in, are they gonna be applicable In the 15 years, in comparison to the upcoming 2 and 5 years, they might be different because this is a little bit far fetched. And a lot of it, as you said, is really dependent on the macroeconomic and geopolitical tensions and stuff like that. So I would say even 5 might be a little bit hard for me to understand. But to be honest, you're a professional. You got Baba for quite a while. I would just leave it up to you, to be honest.
Let's just keep 5 years for now, and then we can always check it. Else, if we can check it and redo it later if we feel like doing that.
Mhm.
So for the discounted rate, we always use 10%, but feel free to play with this yourself once the web app is available. Then the estimated growth rate. So here's the funny thing: we checked on Yahoo Finance as we normally do what the analysts think, and the analysts say it's going to grow with 1.27% per year, which is really on the low side.
Yeah.
I do not agree with that. And if we can, for example, see the average revenue growth for the 5 years and their cash flow growth, it's around 20%, 10% on average that they've been growing the two. I think this is fair. We can even do it a bit lower. So we could, for example, say, okay, it's between 7 and 8%.
Yeah, so if we would say, if we would be experiencing about in the ballpark of inflation solely of around 2 to 3% per year, right? Which is already quite high, especially for China because they have very low inflation. My only concern is, of course, just the growth on the bottom line and top line, right? So meaning free cash flow and the revenue side of things.
Mm-hmm.
So yeah, let's just see. Let's just try 7. Let's not really be too picky about it, and we can also adjust it later.
Yes. For the PE ratio, so we see that the average PE ratio is 22, so we could plug it in for the projected PE ratio of 22.
Yeah.
Required rate of return. Normally, when you buy into index funds, you would like to see a return of 7 to 10%. That's what the SP has been returning historically. But because you're stock picking, you want to have a bit of a high return. And here you can also play around. So normally I do 12%. Kirill is more keen on 11%. But if you also want to do, for example, if you want to have a stock that's really undervalued but has high required, and you want to have a lot of return from it, then you can increase it yourself.
Yeah.
And then the margin of safety, I would put this rather high, maybe 20, 30%, not because of the company or even higher. Maybe that's just my risk tolerance there.
Yeah,
But basically, you know a lot about the company, but there's a lot of uncertainty when it comes to the geopolitics side of things and how it's intertwined within the company. So that's why I would give it 30%. Maybe if I read more into the politics and how it's affecting Baba on on a industry scale or like the company scale, yeah, maybe then I can tone this down. But for now, I would leave it at 30%.
Yeah.
All right, and
And
then
we
we
hit
click
the
the
analyze
analyze button. Yes. All right, and what we see is not quite the overvaluation or the undervaluation. It's trading
Yeah.
for slightly higher. It is quite some percentages, but that's up to you. It's within 20% overvaluation, so it's not that bad, let's say. But it's for you to consider: do you want to pay this premium in such a volatile market, or is it something that you want to consider taking elsewhere? Like you said, Kirill, there are a lot of pros of buying this, like the cheap price, the cheap PE ratio compared to the American competitors. But on a fair valuation, it's really hard buy for me now.
Yeah, and I would also say the biggest question is just the complications, because if you want to buy a stock, you're kind of like, okay, I'm 100% sure it's going to be there. It's going to meet all my criterias for the reasons why I'm buying the stock, right? And I'm pretty sure that nothing is going to happen to it in the upcoming period of time that we projected, right? I cannot say any of these about Alibaba. Not talking about politics, not talking about economic environment. Also, which is really important to highlight, is the cultural part of things, because, for example, the way how Western world is doing things in terms of the business, right, is completely different from Asian market. It's also different from Africa. It's different from, let's say, Eastern Europe and stuff like that, which is also very vital to keep in mind. If you know all of that, if your margin of safety is 0 because you understand everything out of it, sure, could be quite a good buy, no doubt about it. But then again, you have to do your what? Of course, your due diligence.
There you go. And I think with that said, we covered everything. So there you have it. You should do your own due diligence, like Chris said, to look further into whether or not you want to pay this premium. See where those pain points that we addressed, see where they are, see what they did, and whether or not you like them. So thanks, Kirill, again for your insights. Thank you for watching, and we'll see you guys in the next video. Pop, 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 pop. And then you need to subscribe to us, Habibi.
Like right
Please.
now, like today.
Please, 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 please. Okay.
Put your please.
Okay. You ready?
Да.